Hi everyone. Before I start this video, make sure that you're a part of my Discord server by joining the link in the description box below. And in this video, we'll be going over A-Level Accounting 2024 February-March Paper 3-2 question number 1. This is the structured paper 3, which consists of 3 questions, and the total time limit given for this paper is 1 hour and 30 minutes. Since each question is of 25 marks, ideally you should be spending about 30 minutes in order to solve each question. And in this video as well, we'll be attempting to solve this question number 1 under 30 minutes. So without any further delay, let's get started. Ada and Brian had been in partnership, sharing profits and losses equally. They had contributed the same amount of capital. So the capital for both Ada and Brian will be the same amount. On 1st January 2024, Ada's overdrawn current account balance was 3,900. Overdrawn means that this 3,900 should now be paid to the partnership business by Ada. So this will be understood as the debit balance. Then Brian's overdrawn again. So Brian's balance will also be on the debit side. Current account balance was twice that of Ada. So the first thing we're going to do is figure out the current account balance for Brian. And we were told that the amount will be twice that of Ada. So that will be 2 times 3,900, which results in 7,800. And this will be on the debit side since it is overdrawn. Then X Limited was formed on that date, so the date of 1st January 2024, in order to acquire Ada and Brian's partnership business. The terms of the acquisition were as follows. The first one we have is the amount for purchase consideration, which is 3,600, and it would be settled by issuing $1, that's the nominal rate, ordinary shares at par value to the partners equally. So the settlement of purchase consideration is through ordinary shares, and the ordinary shares to both Ada as well as Brian will be equal. It means that we just have to divide this amount of 360,000 by 2. So for Ada, that will be 360,000 by 2, which results in 180,000. And for Brian as well, that will be 360,000 divided by 2, which will be 180,000. And remember that there is no premium in this case because we were told that the ordinary shares were issued at the par value, which is the nominal rate of 1. So each partner will get 180,000 shares itself as well. So the number of shares for Ada as well as Brian will be 180,000, and the value will be 180,000 times our nominal rate of 1, which is still 180,000. Then each partner also agreed to subscribe 20,000 from their personal resources for additional shares at par. Again, we're talking about par value, which is the normal rate of 1. And both the partners will be now subscribing 20,000. And this is from their personal resource. It means that we cannot place this 20,000 as the ordinary shares as part of the settlement or the closing entry within Ada and Brian's capital account for the partnership because they are using personal resources for this 20,000. So we can understand this additional 20,000 as new capital being invested by both Ada and Brian, but into X Limited, not the previous partnership. Then all assets and liabilities will be taken over by X Limited after the following revaluation. So we have been given the book values and we have been given the condition for revaluation. So let's also calculate the revalued amount for each of these. For equipment, we need to increase the book value by 5%. So that is going to be 230,000 times 1 plus 5%, which results in the value of 241,500. For inventory, we need to decrease the book value by 3%. That will be 52,000, which is the book value, times 1 minus 3%. This results in the value of 50,440. Then for trade receivables, we need to decrease the book value by 2%. That will be 72,000, which is the book value, times 1 minus 2%. Which will result in a value of 70,560. For cash and cash equivalents, there will be no change, so the revalued amount is still 18,300. And for trade payables as well, there will be no change, so that will still be 64,000. Okay, then we were told that Ada and Brian would be the directors now. Okay, that is all for the information. Let's take a look at our first question. Now we need to prepare showing the adjustments made during the acquisition on 1st January 2024, the capital accounts of Ada and Brian. We need to show the final settlement to or from each partner. Usually for partnership acquisition, the final settlement will be to or from the partnership bank account, but in this case, we need to show the settlement to or from each partner. Okay, let's prepare the format for our capital account. And we are talking about two different partners in this case. We have Ada and Brian. The very first thing that we note down within our capital account is the opening balance, and it will always be on the credit side. So balance brought down. For this one, we're not given any information regarding the opening balance for the capital account, but we were told that they had contributed the same amount of capital. So the opening balance for both Ada and Brian will have the same amount. Now we need to calculate that amount. In order to do so, we can just utilize our accounting equation, asset equals to capital plus liabilities, because here we have a list of all the assets and liabilities at their book value, and we also have the balance for the current account, and both balances are overdrawn. So we can easily calculate the total capital account. Then we can divide the total capital equally among the two partners because they had contributed the same amount of capital. Okay, so our equation will be asset equals to capital plus liability. But in this case, the current account balance will also be adjusted after the capital account. Alright, so equipment is our asset. So 230,000 goes here. Inventory is an asset. So 52,000. Trade receivable is also an asset, so plus 72,000. Cash and cash equivalents of 18,300. Then this is the total capital account. Now we need to adjust the current account balances. And remember, both the current account balances are debit. It means that they will be negative. So we have negative 3,900 and negative 7,800. So minus 3,900 minus 7,800. And for the liability, we have trade payables of 64,000. So plus 64,000. Now the total capital, which is C in the previous equation, this one, is just going to be 230,000 plus 52,000 plus 72,000 plus 18,300 plus 3,900 plus 7,800 minus 64,000. And this results in the amount of 320,000. Now for the capital balances for Ada as well as Brian, we just need to divide the total capital equally because they had both contributed the same amount. So 320,000 divided by 2, 320,000 divided by 2, which results in the value of 160,000. Let's enter these values as the opening balances. Now, since this is our closing entries to the capital account, we also need to adjust the current account balances here. And for the current account, we know that both partners have debit balances. So we need to adjust 3,900 on the debit side for Ada and 7,800 on the debit side for Brian. Let's do that. So we now have the current account of 3,900 and 7,800. Alright, and since this is a case for acquisition, we also need to enter the profit or loss on acquisition. For that, we need to prepare a realization account. Let's do it right here. And remember, all the assets and liabilities are being taken over by X Limited. So we can first enter the book value of our asset on the debit side of our realization account. So 230,000, 52,000, 72,000 and 18,300. So we have 230,000, 52,000, 72,000 and 18,300. Then we need to enter the liability on the credit side at its book value, so 64,000. Then we need to enter how these assets and liabilities are being settled. And in this case, since all of them are being taken over, the settlement will only be done by the purchase consideration of 360,000. We need to enter this on the credit side, and that's the format. You always need to enter the purchase consideration amount on the credit side of the realization account. So that is the settlement amount for all these assets as well as this liability, which means that we have completed the entries in our realization account. The last thing we need to do is figure out the heavier side, calculate the total, and then calculate the balancing figure on the other side. So in this case, clearly the heavier side is the credit side. So the total will be 64,000 plus 360,000, which results in 424,000. And whenever we have a balancing figure on the debit side for realization account, that will result in profit on realization. So we can first figure out the total amount of profit on realization. That will be 424,000 minus 230,000 minus 52,000 minus 72,000 minus 18,300, which results in the value of 51,700. And now we need to divide it equally among our two partners, because we were told that they shared profits and losses equally. Now the profit on realization for Ada as well as Brian will be 51,700 divided by 2. This results in the amount of 25,850. And remember that profit on realization always increases the capital account balances. That is why we need to enter these two amounts on our credit side under the heading of profit on realization. Which we calculated to be 25,850 for both the partners. Now we need to list down any asset taken over by partners on the debit side, but in this question, no information were given regarding any asset taken over by partners. Then, since this is a case of acquisition, we also need to list down how our purchase consideration is being settled on the debit side of the partner's capital account. In this case, we know that both the partners will be receiving ordinary shares at par value, and the total amount they will be receiving is 180,000 each. So we need to enter these two amounts on the debit side of the capital account, and we can enter it under the heading of X Limited since the ordinary shares belongs to that company. So we have X Limited, and you also need to specify whether this is a debenture or ordinary shares. And the amount is of 180,000. So for this question, I think we have listed down all of the information given within the capital account. Now we just need to enter the final settlement, and we have been told that the final settlement is to be shown to or from each partner. In order to do so, we first need to calculate which side is heavier for both the partners. Alright, so in this case, we can clearly see that Ada's credit side is heavier than the debit side. Let's calculate the total. That will be 160,000 plus 25,850, which results in 185,850. It means that the final settlement for Ada will be shown right here on the debit side. And whenever we show the final settlement on the debit side, it means that Ada will now be receiving the money, usually from the partnership bank account. But in this case, we were told that the final settlement is to or from each partner. It means that Ada will now be receiving the amount from Brian. We can enter it under the heading of Brian. Now let's calculate the balancing figure. That will be 185,850 minus 180,000 minus 3,900, which results in 1,950. Now we need to repeat the same process for Brian. For Brian, we can clearly see that the debit side is heavier than the credit side. So the total will be 7,800 plus 180,000, which results in 185,850. Now we need to show the closing balance or the balancing figure for Brian on the credit side right here. And whenever we have the balancing figure on the credit side, it usually means that the partner will now have to pay that amount into the partnership bank account. But in this case, the final settlement is to or from each partner. Now it just means that this amount will be paid to Ada by Brian. So we can write it under the heading of Ada, and the amount will be 185,850 minus 160,000 minus 25,850, which again results in 1,950. And remember, in this case, the amount should be equal for both the partners, because Brian is now paying 1,950 to Ada, which means that Ada should be receiving the exact same amount. Since we have the final settlement as the same amount for both the partners, it means that our capital account is correct in this case. That's all for the first part. Let's move towards the next one. Now we need to prepare the statement of financial position of X Limited at 1st January 2024. Okay, this one is for X Limited. We are now preparing the statement of financial position. And this is at 1st January 2024. Okay, first of all, let's go over all the balances. Let's figure out the correct balances and then we can enter it at once into our statement of financial position. Okay, let's start with equipment. We can see that the equipment was revalued. So this is the new amount to be entered within X Limited's statement of financial position. For inventory, we again enter the revalued amount. For trade receivables as well, we will enter this amount. And since this is a case of acquisition, there will also be one additional asset, which will be goodwill. Let's calculate it. Remember that this is goodwill acquired, or the purchased goodwill in this case, which can be shown in our statement of financial position as an intangible asset as per the international accounting standards. So we need to calculate this value, and goodwill is always going to be the difference between our purchase consideration and the net asset value. For net asset, we always take our revalued amount, not the book value. Okay, let us first enter the amount for purchase consideration. That is just 360,000. And we need to figure out the net asset from this revalued amount. Remember that net asset is asset minus liability. And the only liability in this case is trade payables. So our net asset value for the revalued amounts will be 241,500 plus 50,440 plus 70,560 plus 18,300 minus 64,000, which results in the value of 316,800. So minus 316,800. This results in the purchase goodwill to have the value of 43,200. Okay, so we have completed the asset section. Now for our equity, in this case, remember that we first gave out the ordinary shares worth 180,000 each to both the partners. And this is at par value, so there will be no share premium for now. So the ordinary share will just be 180 for Ada and another 180 for Brian. And remember that each partner also agreed to subscribe 20,000 for additional shares. It means that our ordinary share will again increase by 20,000 for Ada and 20,000 for Brian. This gives the total ordinary shares to be of 400,000. Now, whenever you are subscribing for ordinary shares, remember that you pay through cash, right? And in this case, it just means that now additional 20,000 will be paid by Ada into X Limited's bank account or the cash and cash equivalents, and additional 20,000 will be paid by Brian into X Limited's bank account. And in this case, we have the heading under cash and cash equivalents. So now for cash and cash equivalents, the value to be stated within our statement of financial position will be 18,300 plus 20,000 paid by Ada plus 20,000 paid by Brian. This results in the value of 58,300. So that's the new balance for our cash and cash equivalents to be shown within X Limited's statement of financial position. Alright, now let's see, we included the ordinary shares, so there will be no other components for equity section. And for the liability, there is only trade payables, and the value will not change. So we can enter it at the value of 64,000 since this was not revalued. Okay, so that is all. Let's start with our non-current assets. So for non-current asset, we have equipment of 241,500 and goodwill of 43,200. So we can enter non-current asset. And the first one will be equipment, or since this is X Limited, I think we can also enter it under the heading of property, plant and equipment. Or you can simply write equipment as well. And the value was 241,500. Then we have the purchased goodwill, which had the value of 43,200. Now the total for our non-current asset will be 241,500 plus 43,200, which results in 284,700. Then we can move towards current assets. Let's take a look at the information. So current asset, we have inventory of 50,440, then the trade receivables of 70,560, and cash and cash equivalents of 58,300. Let's write it down. So we first have inventory, which is the 50,440. We then have trade receivables, which was of 70,560, and we have our cash and cash equivalents. And the value for cash and cash equivalents was 58,300. So the total current asset will be 50,440 plus 70,560 plus 58,300, which results in 179,300. Now we can calculate the value for total assets. That will be 284,700 plus 179,300, which results in 464,000. Now we can move towards our equity section. And we already know that for equity, we will only have ordinary share capital, which has the nominal rate of 1. And we calculated the total ordinary share capital to be of 400,000. Then for the current liability, we have trade payables of 64,000. That will be all for this statement of financial position. So we have 400,000 here. Then for current liabilities, we have trade payables of 64,000. So we can now calculate the total equity and liabilities. That will be 400,000 plus 64,000, which again results in 464,000. And we can see that our total asset is equal to total equity and liabilities, which means that our statement of financial position is correct. That is all for the second part. Let's move towards the next one. Now we have additional information. Calvin, a friend of Brian, is interested in investing in X Limited. Ada and Brian are considering raising additional funds for a project. The directors have two options. The first one is to issue 4% debenture to Calvin. Ada and Brian have been entitled to interest on capital at the rate of 6% when they were in partnership. So we're talking about interest on capital for their partnership business, and the annual interest of the debenture issued will be the same value as the total interest on capital in the partnership. Alright, for option 2, we need to issue $1 ordinary shares to Calvin at par. The value of ordinary shares issued will be the same as the 4% debenture in option 1. For the third part, we need to calculate the amount of debenture to be issued in option 1. So the criteria in this case is that the debenture interest should be equal to the total interest on capital. We know that debenture interest will be 4% times debenture amount. And this should be equal to the total interest on capital right here. So this will be the interest on capital for both Ada as well as Brian. Let's take a look at their capital account balances while they were in partnership. They had the capital balance of 160,000 each, and the rate of interest on capital is given right here, 6%. So the total interest will be 160,000 times 2 times 6%. Times 2 because we are now adding 160,000 again in order to represent the total capital for both Ada and Brian. Or instead, we could have just wrote down the total capital as 320,000 here. Alright, now the amount of debenture is just going to be 320,000 times 6% divided by 4%, which results in the value of 480,000. That is all for the third part. Now, for the fourth one, we need to advise the directors which option they should choose by justifying our answer. And this is a 5 marks, so we need to have 2 comments for option 1, 2 comments for option 2, and a final decision. Okay, let us start with option 1. So for option 1, the first thing we can see is that the interest on debenture will definitely reduce the profit for the year. So the 4% interest charge on debenture will reduce the profit. And okay, in this case, we know that the amount of debenture is 480,000, whereas the total equity we currently have in the business is 400,000. So if we issue this debenture, since the debenture amount is greater than our total equity, this means that our gearing ratio will be more than 50%. Let's write it down. Since the amount of debenture is higher than equity, gearing will be more than 50%, which is of high risk. Now, we will move towards option 2. So option 2 is where we issue $1 ordinary shares to Calvin at par, and we know that the value of ordinary shares to be issued will be the same as 4% debenture. So the value of ordinary shares issued will be 480,000. So the first thing we can write down is that there will be no change in our gearing ratio. So no change in gearing. It will still remain 0% since there is no other non-current liability for X Limited. The other thing we can write down is that since 480,000 is greater than the ordinary shares owned by both Ada and Brian, there might be loss of control of the company. So since 480,000 is higher than current equity, it might result in loss of control for Ada and Brian. Now, based on these factors, we need to make a final decision. So in this case, I would suggest the directors to go with option 1 so that they can maintain their control of the company. So the directors should choose option 1 in order to maintain control over the company. That is all for the first question. If you found this video useful, make sure that you like the video and leave a comment below. And make sure you subscribe to this channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.